Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey Prime investors, Martin Maxwell here, and welcome back to our deep dive into the One Big Beautiful Bill Act. So far we've covered the big picture and then zoomed in on what this law means for earners under $100,000. Today, we're moving up the income ladder into a group that often feels the most squeeze, the upper middle class. We're talking about individuals and families earning between roughly $100,000 and $500,000 a year. If this is you, you're likely a homeowner. You're diligent about saving and investing, but you also pay a significant amount in taxes. For you, this new law isn't just about a few new deductions. It contains one of the most debated and potentially impactful changes in the entire bill. Today, we're talking about the new SALT deduction, the fine print that comes with it, and what it all means for your financial strategy. All right, let's get right to the heart of it. For this income group, the single biggest headline in the big, beautiful bill is the temporary but massive increase in the state and local tax, or SALT deduction. To understand why this is such a big deal, we have to rewind to 2017. The Tax Cuts and Jobs Act placed a $10,000 cap on the amount of state and local taxes, which includes property taxes and either state income or sales taxes that you could deduct on your federal return. For homeowners in high-tax states like California, New York, New Jersey, and Maryland, this was a brutal hit. Many were paying $20,000, $30,000 or more in these taxes, but could only get a federal tax break on the first $10,000. The Big Beautiful Bill provides significant, though temporary, relief. For tax years 2025 through 2029, the SALT deduction cap is being quadrupled from $10,000 to $40,000 per household, $20,000 for married couples filing separately. Let's make that tangible. Imagine you're a family in a New York suburb with a combined income of $250,000. You pay $18,000 in property taxes and $15,000 in state income taxes for a total of $30,000 in SALT. Under the old rules, you could only deduct $10,000 of that. The other $23,000 was effectively non-deductible at the federal level. Under the new rules, you can now deduct that entire $33,000. At a 24% federal tax bracket, that extra $23,000 deduction translates to a direct tax savings of $5,520. That's real money back in your pocket. For many in this bracket, this change alone will make it worthwhile to itemize their deductions again, rather than taking the standard deduction. Now, a $5,000 tax savings sounds fantastic, but as with any major tax law, you have to read the fine print. And there are two big gotchas here that you need to be aware of. The first is the alternative minimum tax, or AMT. The AMT is essentially a parallel tax system. It was designed to ensure that high-income people couldn't use too many deductions to wipe out their tax liability entirely. When you calculate your taxes, you have to figure it out the regular way, and then the AMT way, and pay whichever is higher. Here's the trap. The SALT deduction is one of the big deductions that gets added back into your income when calculating the AMT. So if you take a huge $40,000 SALT deduction, it could push you over the threshold and trigger the AMT, which could claw back some or all of the tax savings you thought you were getting. This is especially a risk for people with high state and local taxes and relatively few other itemized deductions. The second piece of fine print is the income phase-out. That new, generous $40,000 SALT cap is not for everyone. The benefit begins to phase out for taxpayers with a modified adjusted gross income above $500,000. The phase-out is pretty aggressive. For every dollar you earn over that $500,000 mark, your potential SALT deduction is reduced. It doesn't disappear completely, but it shrinks until it eventually bottoms out back at the old $10,000 cap for the highest earners. So this relief is very specifically targeted at that upper middle income range. This is getting complicated, right? This is where we move from just understanding the rules to building a real strategy. Let's break down the key questions you should be asking. First, the big one. Should I be itemizing my deductions now? For many, especially homeowners in high-tax states, the answer is likely yes. The math has fundamentally shifted. If your state and local taxes alone are over the standard deduction amount, which is about $31,500 for a married couple, then itemizing is almost a no-brainer. But you still have to run the numbers. If you live in a state with no income tax like Florida or Texas, and your property taxes are, say, $12,000, you'd still need significant other deductions like mortgage interest and charitable giving to make itemizing worthwhile. Next, how do you handle that AMT trap? The key is proactive planning. You need to run projections to see if you're at risk of hitting the AMT. If you are, you might look at strategies to manage your income or time your deductions differently. For example, it might make sense to bunch your charitable contributions, making 2 years' worth of donations in a single year, to get a larger deduction in 1 year and take the standard deduction in the other. It's all about not being surprised in April. Finally, what if your income is rising and getting close to that $500,000 phase-out cliff? My number one piece of advice is to plan ahead. Don't wait until your income crosses the line. If you know a big bonus or a stock vesting is coming that will push you over the threshold, you need to think about it in advance. You might look at maximizing contributions to tax-deferred retirement accounts like a 401k to lower your MAGI. You could also consider tax loss harvesting in your investment portfolio to offset gains. The goal is to legally and strategically manage your income to stay below that phase-out threshold for as long as possible to take full advantage of that SALT deduction. The worst thing you can do is be reactive. The key takeaway for the squeezed middle: this bill offers a huge but temporary opportunity with the expanded SALT deduction, but it's not automatic. You need a plan, you need to be aware of the pitfalls like the AMT, and you need to be proactive, not reactive. This is a perfect example of where doing your research and preparation, the first 2 steps of our Prime framework, really pays off. Next week, in our final episode of this series, we're looking at the top of the pyramid, high earners making over $500,000. For them, the new law is a complex mix of shrinking deductions and major investment wins. You won't want to miss it. Your challenge today: if you're a homeowner, pull out your property tax bill and your last state tax return. Add up your total state and local taxes for the year. How does that number compare to the new standard deduction of $31,500 for a married couple or $15,750 for a single person? This simple calculation will give you a very clear idea of whether the new SALT deduction will be a game changer for you. Thanks for tuning in. I'm Martin Maxwell. Keep learning, stay strategic, and keep building, one smart move at a time.